Hello, and welcome to the headline segment of Making Sense of Markets Quarter 2, 2017. My name is Matthew Carvalho, Director of Investment Research here at Loring Ward, and I'll be your host for this segment. The headline segment is meant to put some perspective around topics that you may be seeing in the financial press and provide context for how those issues may impact a long-term investor. Now in Quarter 2, I noticed a variety of headlines focused on the active versus passive management debate. And a higher frequency of those were worried that too many investors were moving to more passively managed vehicles. For example, on April 7th, we saw Passive Investments Far From Perfect from Think Advisor. April 17th is Passive Investing Craze The Next Tulip Bulb Mania from Wealth Management. April 21st, Passive Investing is Popular But Ignores Value. That was in Forbes. Later on in the quarter, May 29th, we saw from the Financial Times The Hidden Dangers of Passive Investing. And then towards the end of the quarter in Bloomberg, we saw headlines such as, "Who's worried about passive investing?" One additional quote really caught my eye from Forbes, and they said, "Today's fad is index funds that track the Standard & Poor's 500. True, the average soundly beat most stock funds over the past decade, but is this an eternal truth or simply a transitory one?" Well, it turns out that people have doubted the trend away from active managers would persist all the way back to this article in 1990. Let's take a quick step back here to highlight the differences between active and passive. Active managers have two things at their disposal. They can try to predict which individual stocks will outperform, or they can make a guess on the direction and timing of the overall market. Passive managers do not attempt to outguess the market. They believe in buying a diversified group of securities, and passive investments tend to be more tax efficient than active investments, since passive managers do not buy or sell as frequently as active managers. And that frequent buying and selling can have a real impact on taxes paid. The question to ask yourself here is, which of these two strategies gives you the best chance of getting those market returns that your financial plan is based on? Here are the results of the latest Standard & Poor's Index versus Active scorecard, and once again the results don't look good for active managers. This study looks at the entire universe of active managers and groups them into their respective asset classes. It then looks at what percent of those funds would have underperformed an index representative of that asset class. If we think back to that Forbes article which mentioned active managers on average trailing the S&P 500 over the 10 years to 1990, we can see that that's still the case today. Over the 10 years through 2016, we see that only 15.4% of active managers outperformed the index, which meant that you had an 85% chance of being invested in an active manager who underperformed. We can see similar cases for a variety of other asset classes as shown on this table. Yet, even if that percentage of managers who outperformed was small, couldn't we just invest in those who did have a good historical track record? Well, the S&P Dow Jones team wanted to answer that question in a recent study they performed. They looked at 2,862 mutual funds that had been around for at least 12 months as of March 2010. They narrowed in on specifically US-oriented funds. Now, if you look just at the top quartile, that top 25%, and track their performance for the following 12 months period going forward, you found that an amazingly small number of funds actually managed to achieve top quartile performance in subsequent years. Only 2 funds by 2014, and by 2015, 0 funds had remained top performers over that time period. Nobel Prize winner and Stanford Business School professor Bill Sharpe noted the inability of active managers as a whole to outperform the market after fees in his 1990 paper, The Arithmetic of Active Management. In this paper, he said if active and passive management styles are defined in sensible ways, it must be the case that before cost, the return on the average actively managed dollar will equal the return on the average passively managed dollar, and that after cost, the return on the average actively managed dollar will be less than the return on the average passively managed dollar. Now what that means is that if you picture the entire market of stocks, each individual active manager may be focusing on their own area of specialization. Maybe it's a mid-cap growth stocks or large value stocks. But as you start to aggregate those positions, you realize that as a whole, active managers are going to own the entire market. And if you're owning the entire market, you're getting market exposure. And if you're paying higher active management fees to own the market, on average, you're going to underperform. Those hurdles, the low odds of beating a benchmark, the inability of outperformance to persist, and the math of why active managers as a whole would be expected to underperform, are leading to significant dollars moving out of active management. Over the 3 years to May, $650 billion has flown out of actively managed mutual funds and ETFs, while $1.5 trillion has moved into passively managed investments. So what might you want to look for in your own investments? Well, things like low turnover, broad diversification, low cash drag, low security, sector, or country concentration, consistent exposure to the desired areas of the market, and good value for the expenses paid are all areas that we think investors should consider. And by considering these factors for your own investment vehicles, you can then spend more of your time making sure that you are on track with your own financial plan, rather than worrying about what any active manager may be doing. For additional commentary, please view the Making Sense of Markets portion of the Loring Ward channel on YouTube.